everyone. So Dixon has been one of the biggest wealth creators in last few years. But then in last few months, there has been a massive correction in its share price. And of late, I'm getting a lot of queries in terms of what should you do with it. Now that the stock has fallen significantly, is it a time to consider adding or there can be more pain ahead? So now that its Q3 results are out, I thought of quickly sharing the updates and my viewpoint on the company. Right, so now if you quickly look at its performance, its sales are flat, just 2% up year on year. EBITDA is also flat, just 6% up. And mind you, this is one company that has grown at 40, 50, 60% rate in the past. Right, so it looks like market already anticipated this kind of weakness and hence the stock is already corrected 40, 45%. Now interestingly, if you look at the net profit, it is still showing up by 68%. So what explained that? When the sales and EBITDA are down significantly, why? Its net profit is up 68%. So if you go to screener, you'd see that there's something called other income, right? And that is up significantly as compared to your Q3 FY25, right? Nearly 129 crores of gain. And that is because of their stake sale that they've done in one of the company. That resulted in net profit. So this is not a part of their core operating business, and that's where you cannot consider this kind of growth, right? So if you look at their presentation, you would know that their PAT is actually down by 1% year on year, excluding that gain, right? So clearly a flattish performance, which has been a disappointment for a company like Dixon that was growing leaps and bounds, and that's where its stock price is also corrected. Now let's try to understand their individual business performance and where is the pain, right? So first of all, if you look at their mobile and EMS division, which is by the way their biggest growth engine, in fact it contributes nearly 90% in the revenue and more than 80% in company's operating profit. So if you look at the revenue growth, it is only 5% on year basis and down by 27% quarter on quarter. Operating profit, if you look at it, it's up by only 9% and down by 26% quarter on quarter. So mobile, which was their highest growth division, has seen a sharp decline in terms of growth. And if you look at other numbers, your consumer electronics has also been a disappointment, although its contribution is very small, just 5% in revenue and 6% in operating profit. And if you look at home appliances also, although this division has shown some recovery, but still nothing great, right? And their contribution is again very small. So if you look at broadly, the biggest reason for underperformance has been due to their mobile division, which is the key growth driver and the highest contributor in company's top line and bottom line. Now, what is the reason why their numbers are not that great? So I attended the con call and I have written down some notes for their underperformance, and they've identified 5-6 reasons. First reason they are saying is because of the global memory price inflation. Because of demand in AI and data center, the memory that is required, memory chips that are required in mobile phones everywhere, their prices have gone up significantly. And because of this increase in raw material price, their margins have got impacted and also the demand has been impacted. Second, they are saying there's a contraction in smartphone market. Again, very, very important point to note. So overall, Indian smartphone market has fallen by 7% year on year. Now, what is the reason for it? First of all, they are saying is that because of post-festive slowdown. Second, they are saying is elevated channel inventory, very important. So they are saying the inventories are very high at various channel level and the demand was not enough and that resulted in higher inventory as compared to demand. Again, third factor is depreciating rupee, and because of all these factors, it impacted the mass market affordability. Okay, so that is again second reason for contraction in smartphone market. Third is they're saying supply chain squeeze, right? Because there's the global suppliers have shifted their capacity towards artificial intelligence application, and that has resulted in squeeze and persistent supply constraint for the smartphone segment. Fourth factor is their consumer electronics moderation, so LED TV segment that has also seen some temporary moderation in demand. Next is their appliances also, although it contributes small, but these segments have also seen a slowdown, right? So I hope it makes sense. The reasons that management has given, the key reason is the contraction in smartphone market and some supply chain squeeze and your memory price inflation. Now, what is the expectation? So management has reiterated that they still aim to reach 1 lakh crore of top line in next 3 to 4 years. Very, very important. So today the top line is around 48,000 crore, which means they intend to grow at 20 to 25% CAGR rate over the next 3 to 4 years. We'll discuss it this calculation, but yeah, that is the growth. And please remember, the company earlier was growing at 40, 50, 60% top line. So if you look at it, earlier the growth was 40, 50%, and now in fact in the recent video that I've discussed, I clearly mentioned that now earlier the base was small. Now it is already, its top line is already 48, 50,000 crore. So from here you cannot expect 40, 50, 60% CAGR, and that's what management is also saying. They are targeting 1 lakh crore of top line. Now here again the question is how this company is going to achieve this kind of top line, like doubling the revenue over the next 3 to 4 years. How is it going to happen? So they have shared certain growth strategies. First is deep backward integration. So what company is trying to do is it is trying to backward integrate into their component manufacturing, right? And that is going to not only help the company in terms of revenue growth, but it can also result in margin expansion, right? So what they're saying is for display module, they've done a joint venture with HKC, where they're constructing a facility to produce smartphone and notebook displays. Trials scheduled for Q2 FY27. For camera modules, they're expanding the capacity from 40 million to 190 to 200 million. And then for IT components, they've done a joint venture to begin mass production of SSD and memory modules in Q2 FY27. And various other components, right? So first factor would be the deep backward integration. So backward integrating to produce components as well, not just the assembly. Second is strategic partnership and capacity expansion. So one of their key growth driver in the near term could be their Vivo partnership. Recently, there have been news on Dixon Vivo partnership, which is still not confirmed, but management is highly confident in receiving government approval from Vivo joint venture. And that can be a major growth trigger. Second, there's another partnership with Longcheer joint venture. Again, this is a Chinese firm where they're producing a 4 lakh square feet of facility to manufacture the smartphones and IoT devices. That would be operational by Q2 of FY27. Right, so they're targeting nearly 8 to 10 million units that's the volume they're targeting. And mobile facility, they're constructing 1 million square feet facility that would be completed in Q1 of FY27. Right, so that is the plan on the strategic partnership and capacity expansion that can result in the 1 lakh crore target revenue. Third is diversification into new high growth vertical. Company does not want to only depend upon mobiles. They are targeting IT hardwares, industrial and automotive EMS, right? So not just your mobile, but also other side of the electronic segment, then telecom and premium appliances, right? So that's again third growth strategy. Fourth is export-led growth, right? They also want to export their mobile exports, lighting and TV, right? So that can be fourth growth driver. And fifth is market consolidation and premiumization. Obviously, with the increase in demand for premium products in the electronic space, it can result in better growth, top line as well as margin expansion, right? So these are the 4-5 strategies where management intend to that can help management to achieve their 1 lakh crore top line. Now again there are few specific guidance on Capex and margin. So overall they're saying that for FY26 there's a plan to do a Capex of 1100 to 1200 crore of overall Capex budget, and again within that they've certain 1100 to 1200 for display business across phases and 250 to 300 crore for camera module. Now again very important point is on the margin. So what they're saying is the mobile margins can remain between 2.8 to 3.2% over the next 12 months. And here very important point is the PLI impact. I don't know how many of you are aware, but in March 31 March 26, this PLI that government started on mobile, where Dixon has been a big beneficiary, it is going to end. And if the government does not extend that PLI benefit, it is going to impact company's margin by 0.5% for the mobile division. And again, since it contributes nearly 80-90% in the business, it is going to impact the margin of entire company, right? So if your PLI scheme does not get extended, their margins can fall. That can impact their profitability growth in the near term. That said, what management is saying that since they are doing backward integration over the period of time, next few quarters, it is going to result in, it will compensate the PLI discontinuation if that happens, right? So that is the guidance on Capex and margin. Now, overall, what should you do, right? Now that you know the management guidance on the growth and the certain risk like the PLI discontinuation. So if you look at the valuation, Dixon is trading at a PE of around 44, 45. And what a massive derating from the highs of 100, 150, 200 PE multiples to now below 50. That said, is it a good valuation to consider buying it? So if you quickly look at the numbers, like if Dixon can achieve their 1 lakh crore top line in 3 years, that would translate to a revenue growth of 26-27%. If Dixon can achieve 1 lakh crore top line in 4 years, that would translate to a revenue growth of 20%, which means over the next 3-4 years, Dixon can grow its top line in the range of 20 to 25%, which is not bad at all. That said, as compared to the previous growth of 50-60%, it is nearly half, right? So you cannot expect a very high PE multiple. Earlier, even a PE of 60 was not bad because company was growing at that fast rate. But today, even with 20-25% kind of growth, is it worth paying a PE multiple of 44? That's a question. Now that's on the top line side. What about the bottom line? So here a couple of things. One is because of the backward integration, management is expecting margin expansion in coming quarter. That said, if the PLI does not extend, it is going to have an immediate impact of 0.5% on the margin. And mind you, their margins are not that high, right? So the 4% margin. So if the margin falls by 0.5%, it can impact the profitability in the near term. So I hope it makes sense. Now you know a clear picture on Dixon. As far as opportunity is concerned, there's a massive opportunity. Electronic sector in India is still in nascent stage and Dixon is undoubtedly the leader in that space. So growth is going to be there. But then there are certain risks like your PLI does not get extended, or let's say the mobile division, how is the growth would be. Considering all these things, the only question is it worth paying a PE of 44? Right? So in my opinion, obviously given an option, I would like to consider it at a PE of around 35. Right? I still believe there's scope for some sort of valuation derating. Again, I'm not saying that there can be, you can consider PE of 20-25. No, because company would continue to grow at a good rate. But that said, is it worth paying a PE of 44? Again, it's a very debatable topic. Like I said, I would like to see Dixon in the range of, maybe 35 PE multiple. That would be better. For that, it has to fall another 20%. But overall, I believe the growth is going to be there. It's only a question of how much company can grow and what market thinks is a justified valuation, right? So in my opinion, couple of very important factors to watch out. One is the government decision of PLI. If it extend that, I think Dixon, it will be very, very positive news. And the Vivo deal, if that happens, again, market will cheer it. So overall, I think Dixon may consolidate from here. I don't expect a very sharp correction unless the market, market is always unexpected. So what is happening today, there can be further correction. That said, I think now we are in a very comfortable position. And based on that, you decide whether it is worth paying a PE of 44 or not. So that's it from my side. Hope it makes sense. Let me know in the comment what you think, whether it is an opportunity to consider buying Dixon, or you think that there can be further correction and it's worth waiting for better opportunity. So that's it from my side. I'll see you next video. Till then, take care.